George is asking, if we are risk averse, is it better to wait until we're out of quad 4 to press ahead with some of the best idea longs? He's thinking of longs that are in sector that are not particularly strong in quad 4, like communications. Disney looks like a great idea, but he doesn't want to buy it early.
Yeah, I love how you think about that. And I'm in. Is it George?
George, yeah.
George, I'm totally in bed with you on this. I mean, I'm back from vacation. I can, like as my wife says, get back to work. And I'm in bed with you today, George. I mean, you and I are gonna sleep together on this, proverbially, because I have the exact same thing in my head. I got great ideas, but you know what's a better idea, George? Is to get up early, get up on time, sleep properly. Those are better things. We don't just have to have great ideas to do those things all the time. So I have plenty. You know how many long ideas I have, George, in investing ideas, which is ostensibly where I put the ideas I'd be in? Two. You know how many longs I have, George, in real-time alerts? One, okay? Treasuries, short-term. So again,
really
what I have in my core asset allocation different. Yes, some people over time are like, well, he said this and he did that. No, I am, again, uniquely and squarely focused on quad 4 and Q3. And then when I decide, via my process, not licking my finger or waking up to a tweet, then I'll get back in bed with the things that I like. That's the whole point of risk management. Timing matters. Quad 4 matters, okay? And reflation in general, that's why the market doesn't believe that the Fed is ready to cut by enough. To reflate asset prices, to be clear, to devalue the dollar explicitly, they need to be more dovish than the market expects, okay? Mm-hmm. So that's the main thing. The market's going to, as I said earlier, going to start cutting interest rates for the Fed anyway. But again, to get the dollar to break, the Fed has to be more dovish than the market expects, which the market needs to tell the Fed that by going down faster. So again, this is the whole point. And a lot of you, when you look at that table, you're like, oh, I want to go to quad 2. My business only goes up in quad 2. I got it, but you just incurred a 14% drawdown, high beta, for example. 14% high beta. Show the style factors, Josephine, if you can, from last week. Within the lens of what is it in your stocks portfolio. If you had high beta stocks, you're down 2.1% last week and down 14 in a month. 14% in a month, okay? So again, this is going back to maybe and apologies in advance for the life lessons if you didn't sign up for that, but in my life, if I lost, this would be the equivalent of taking my gold, treasuries, utilities, fully loaded, fully allocated asset portfolio and basically taking it down 14% in a month.
It's unbelievable.
Would you be a subscriber after that?
No.
I would not be happy about that. That is not good. Okay? So again, for those of you that screwed it up, and I know some of you did because I screw things up all the time, and if you never do, then that's awesome. But again, if you did screw it up and you're like, well, I think the market's saying that we're going to just not, we've priced in fully quad 4. We had that question from a lot of hedge funds. Some of them have gone away. Well, hasn't the market priced in the quad 4 in Q3? It obviously hasn't. Okay, so again, whether or not those twos actually manifest in the data, don't forget that that's going to be intra-quarter data. So we're going to have to actually get into the fourth quarter before we actually get that data. And there's a big black hole in front of it. Hence the black hole metaphor, which is all the worst of the data is going to be reported in, as we said, in July, August, and September. So again, that's a good way to summarize. I see a lot of questions about this. When do I go? When do I go? When do I not go? Every day, that's the only thing I want to answer when it comes to this entire process. So hopefully you can be patient alongside me and execute the process, or at least try to as best as you can alongside me.
Yeah, absolutely. And I'll make one quick correction. The worst of the data will be recorded in July, August, and September, and reported in August, September, and October. Right. In terms of the high frequency data that's sort of feeding into our nowcast models.
And the October period, don't forget, is when we get Q3 earnings season. And I didn't hit on that this morning, but as you can see, as earnings season ends and people go outright on vacay for the last week, that's why I came back. You like to work when other people aren't because you're going to have liquidity traps in the market. Mm-hmm. 480 companies have reported we're on the lows. This is the worst earnings growth rate has been. And as you see, you've seen a broadening of sectors that are in an earnings recession. Effectively half of them, okay? And that's going to be more than half of them in the third quarter, and the aggregate earnings number is going to be negative in the third quarter. So that's the other big thing that Wall Street has to come back to after their summertime, which is companies are going to be pre-announcing negatively. There's no bank stock that people are going to believe that earnings beat expectations when the 10s-2 spread is at 0. Okay, that's not going to work. I mean, it's not going to happen. And if it does happen, you look at companies like Foot Locker last week that imploded on Friday down, I think 19%, Brian said. Yeah, what they should have did was guide to the truthful numbers. Instead, they kept guidance up for the coming quarters, so people just pounded the stock. So you're going to enter that period where people don't believe the Fed, they don't believe Trump, and they don't believe the companies. What could possibly go wrong?